The US dollar had another eventful week, but this time the story wasn't just about economic data. It was about a change in market expectations. At the start of the week, the dollar index pushed above the 101 level as investors sought safety following tensions in the Middle East and concerns over global growth. But as the week progressed, those tensions began to fade. The key driver was the latest US labor market data. June's non-farm payrolls report showed the US economy added just 57,000 jobs, well below expectations of 110,000, pointing to a slowing labor market. At the same time, unemployment held steady and wage growth remained contained. For markets, this changed the conversation. Investors are now increasingly questioning whether the Federal Reserve will be able to keep interest rates elevated for much longer. Expectations for another rate hike have eased, and traders are once again discussing the possibility of rate cuts later this year. At the same time, geopolitical fears also started to cool. Progress in US-Iran negotiations and improving shipping activity through the Strait of Hormuz reduced demand for traditional safe haven assets, including the US dollar. The result? The dollar index has pulled back from this week's highs and is now hovering around the 100.50 to 101 region. Looking at the chart, the dollar remains above key support near 100.49, but it has struggled to sustain momentum above the 101.50 to 101.78 resistance zone. So, the market's main theme this week has been a battle between two forces: a slowing US economy which is weighing on the dollar, and lingering global uncertainty which continues to provide some support. The next major catalyst will be incoming inflation data and further comments from Federal Reserve officials, as traders look for clues on the future path of interest rates. Do you think the dollar has started a bigger correction, or is this simply a pause before another move higher? Let us know your thoughts in the comments below.